VAT can be confusing, but it doesn't have to be. Should you register, and if so, which scheme is the right one for you? The current VAT threshold is £90,000 per annum. This means if you're expected to turn over more than £90,000 in the year, then you legally must register for VAT. However, if your turnover is less than £90,000, you may choose to voluntarily register. There is a number of pros and cons for this. The pros of this are to portray a bigger image for those who want to be seen as a bigger business as opposed to just a one-man, one-woman band. Another is that you are able to reclaim the VAT on any VATable expenses that you may have incurred during the year. And finally, you may make savings based on going onto the flat rate scheme, of which we will cover later on in the video. The cons of registering for VAT, generally speaking, will come down to who your end client is. If your end client is a consumer, then all of a sudden your fees increase by 20% as they're likely not registered for VAT and aren't in a position to reclaim. Additionally, you will then be required to put in VAT returns either each quarter or on an annual basis. This increases the administration burden that you will face throughout the year. As with all VAT, the burden of record keeping and admin will increase, with you now having to keep VAT receipts and also ensure that you're claiming correctly based on the VAT that has been incurred. When it comes to VAT, there is a number of different schemes that you can be on, one of which is the flat rate scheme. The flat rate scheme is great for those who have minimal expenses and therefore are able to pay over a set percentage based on the sector that they will drop into. Depending on the sector that you fall into, this will then dictate the level of percentage you need to pay across to HMRC when it comes to the VAT. For example, if you're a service-based business with limited cost of sales, if not none at all, you will find yourself into the limited cost trader sector, which is currently at 16.5%. Now, 16.5% may seem like you're getting a good deal. However, this is calculated based on the gross income, which is inclusive of the 20% VAT. One of the main benefits with the flat rate scheme, in your first year, you get a 1% discount. This further enhances the potential savings that can be made by joining the scheme. The downside of the flat rate scheme is that you are unable to reclaim any VAT unless it's on capital expenditure over £2,000. Now, with the flat rate scheme, you are only able to join if your turnover is going to be less than £150,000 per annum. If you was to leave the flat rate scheme at any point, then you are unable to rejoin the scheme within the next 12 months. In order to stay on the flat rate scheme, your turnover must be less than £230,000, and that is inclusive of VAT. The flat rate scheme will reduce your administration burden. One of the main reasons for the scheme is for those who don't want to be collecting VAT receipts and want to keep their administration down to a minimum. The next scheme is the standard scheme. Now, this is where you would pay 20% on top of your sales made, and you would also be able to reclaim 20% on any VATable expenses that are incurred. Clues in the title of this one, it is the standard scheme because it is the most common scheme that businesses will be on. And finally, the cash accounting scheme. Unlike the standard scheme, with cash accounting, the name's on the tin. When you receive the income or when you make the purchase, you are then at that point eligible to reclaim or pay the VAT. Normally on the standard scheme, you will pay your VAT upon invoice being produced or bill being received, no matter whether they've been paid or not. The cash accounting scheme is great for those who wish to be able to only pay the VAT when they physically receive the funds, as opposed to the cash flow implications of having to pay the VAT over when you've not necessarily received the cash into the bank. To join the scheme, your VAT taxable turnover must be less than 1.35 million. You're not able to use the cash accounting scheme if you're not up to date with both payments and submission of the returns for the VAT, and also if you've committed a VAT offence within the last 12 months, such as VAT evasion. The cash accounting scheme cannot be combined with the flat rate scheme. However, the flat rate scheme does have its own cash accounting system, which you will be able to apply upon registration. If your turnover is more than 1.6 million, then at that point you must leave the cash accounting scheme and go back onto the invoice and accruals basis. Whichever VAT scheme you've decided on, don't forget pre-registration VAT. If your business incurred any VATable expenses prior to registration of VAT, you may potentially be able to go back and claim them on your first VAT return. For goods, you are able to go back up to 4 years, and for services, you're able to go back up to 6 months. This could come in handy on the first return, as you may even find yourself getting a small VAT refund. VAT isn't one size fits all. The right decision can save you thousands. Seek expert advice to ensure that you're applying for the right scheme from the get-go.